Hello, my name is Zeigler. Today I would like to discuss crisis prevention as well as propose a three-step set of fiscal policies that I believe would help prevent future financial recessions. Now, in order to develop these policies, it's important to first understand the factors contributing to the 2008 housing and credit crises. First is the who behind the crises. You hear a lot of people bringing up the name Alan Greenspan, the chairman of the central bank at the time of the recession. The central bank was blamed for keeping the Fed funds rate at such a low level that it discouraged investment in treasury bonds and forced many financial institutions to look for other, less reputable places to invest their funds. You also see blame directed towards lenders who offered unethical loans to unqualified borrowers without asking for income verification or sometimes lying about income outright. You also see the same blame directed towards borrowers who took out loans that they conceivably knew was beyond their ability to pay. People also blame credit agencies who gave mortgage-backed bonds backed with subprime mortgages, AAA ratings, the same ratings as government bonds, which led investors to believe that these toxic assets were just as reliable as government alternatives. You also see blame directed at CDO companies which packaged and sold these toxic securities as AAA bonds to investors. And finally, there is blame directed towards financial institutions such as commercial and investment banks, which engaged in risky, irresponsible investments with clients' funds. Moving on to what the consequences were, there was the housing crisis, in which an unprecedented number of homes were seen going into foreclosure because so many NINA loans had gone out and so many people had defaulted on them. And also because the speculation bubble had driven housing prices up so high that many people were not able to afford to buy homes, and even more people were forced to default on their mortgages. There was also the worldwide credit crisis. After seeing what had happened with the speculation bubble with falsely backed investments and falsely backed credit ratings, many investors were completely unwilling to engage in any risk. This meant that a lot of companies reliant upon credit were forced to close. Economic growth stagnated because there was less industrial investment. And of course, because the economy was stagnating and companies were closing, you see unemployment rising. So just because of these two factors, housing and credit, you see over all of our economic evils coming into play. Moving on to where the crisis affected, of course, it affected the housing markets, the banks, the investment industry, and the stock market. But it also severely affected the central banks of foreign countries, especially those in Western Europe and the EU countries. Moving on to why the problems were allowed to exist. First of all, there was lax regulation of the mortgage industry and banks that had been deregulated since the mid-1980s. So, traditionally separate commercial and investment banks had been brought together, meaning that our banks in which we get our home loans and keep our savings were now allowed to participate in risky investment procedures such as derivatives trades and mortgage-backed securities. There was also the massive return on mortgage-backed securities, which provided incentive for many traditionally safe banks and financial institutions to engage in far riskier loans. Furthermore, because demand drove the housing market prices up, people expected that the prices would continue to rise indefinitely. This meant that even though there was a huge risk associated with buying into mortgage-backed securities, most people felt that even if their investment fell through, they would still be left with a house worth more than it was originally purchased for. So the speculative bubble continued to drive prices and demand higher while incomes remained relatively steady. Furthermore, the rapid bundling and trade of mortgage-backed securities meant that no toxic asset was kept in the same hands for very long. This reduced accountability for loaners and borrowers and transferred risk up the chain until it was virtually unnoticeable behind AAA credit ratings. So What this cycle ended up with was a demand for mortgage-backed securities driving up prices, and those prices creating more demand. So you ended up with a vicious cycle in which demand and prices continued to rise while wages and actual home values remained relatively steady when the crisis began to emerge. In the late 2006, that was when home prices and CDO performances first began to fall. So the vastly lucrative CDO companies were beginning to see profits drop, just small amounts. Around early 2007, performance began to sink drastically. Many firms refused to buy loans from the mortgage-backed security companies, and the smaller banks, which were heavily leveraged because they had taken out so much money to purchase mortgage-backed securities, were forced to close because they could not follow through on their investments. In 2008, that was when everything fell through. Financial institutions were going bankrupt, and many credit-reliant companies were forced to close. This resulted in rapid inflation, a stock market crash, and rising unemployment. Most of us are familiar with this still. The response policies tried by the federal government. Here we have three: the Economic Stimulus Act of 2008, which was money in direct stimulus checks to the lower and middle class; the Troubled Assets Relief Program, also known as TARP, which was also known as the bailout for banks who were failing, in which $700 billion of direct government transfers and tax cuts were used to help buoy the failing system. And finally, there's the American Recovery and Reinvestment Act, which was about $1 trillion in government transfers and purchases. Now, what all these three policies have in common is they were all designed to use government spending or transfers to close the recessionary gap caused by the 2008 crisis. Unfortunately, the results from these policies are very hotly debated. While none of them seem to have completely cured the problem, many argue that they helped prevent us from falling into a more drastic depression. Others argue they didn't really help at all, but just put our government into further debt. Regardless of that, the problem with these policies is they are completely reactionary, meaning that they can't be put into effect until after a crisis has already happened. And so, since we're looking at prevention policies, we don't want to focus on discretionary spending tactics like these. Now, another relatively recent act put forward by the Obama administration was the Dodd-Frank Wall Street Reform and Consumer Protection Act. This imposed new regulations on banks' investments and expanded the powers of federal regulation organizations such as the SEC and the FDIC, which date back to FDR's New Deal. Now, this is designed more to regulate risky investment practices and to increase transparency of our banks, and also to increase the powers of traditional federal regulatory committees so that they can kind of act as financial watchdogs in the system. And this is more of the policy we're going to focus on because it helps prevent financial crises before they happen. This is part 2 of my financial crisis prevention presentation. Here I would like to present my policy proposals that I believe would help prevent future economic recessions. The primary goal behind all of my proposals is to increase reliability and decrease risk within commercial banking organizations. Now, my first proposal is to reform our credit rating processes. Back in the early 2000s, when you first started seeing the problems of subprime mortgages emerge, you had many banking organizations giving loans out to unqualified buyers. Many of these loans were based upon falsified income information or simply given with the complete lack of income information. I propose that we require tax forms as proof of income for the recipients of loans. Secondly, I think that we should make this availability of this information mandatory in order to receive a credit rating. Third, I think we should allow federal regulatory committees, such as the SEC, the ability to audit credit rating unions and ensure that the individual mortgages within packaged CDOs are all legitimate. Now, This proposal would help the economy in two different ways. The first is that by helping to ensure authentic credit scores, the federal government can prevent speculation such as the one during the 2008 speculation bubble, in which the expectations for the housing market were so high that aggregate demand was driven up based on false expectations and faulty credit scores, which both encouraged investors into buying toxic assets. This artificially drove up prices and demand within the housing market, even while wages remained relatively stable. By ensuring that credit ratings are authentic, we would help to stabilize demand and ensure that it is not driven up under false pretenses. Secondly, it would help prevent a recessionary gap like the one seen after the speculation bubble popped. Because after the 2008 credit crisis, many of the investors began to lose their faith in the current system, meaning their faith in the abilities of lendees to pay back and the ability of credit rating companies to provide honest information. And this meant that they began to cease loaning money. And when the investors stop loaning money, that means that aggregate demand goes down because there's less money going into industrial growth, less money going into consumer and investment spending. And I believe that by providing authentic credit scores, the federal government can help increase demand for investors to put their money back into the economy by restoring trust in the credit rating process. So in conclusion, by restoring faith in credit ratings, the federal government can increase investment spending. And the more investment spending goes into industrial growth and job creation, the more consumer spending we see. This serves to raise economic growth and lower unemployment, serving two of our economic goals. My second policy proposal is to increase reserve restrictions on banks' lending and borrowing practices. Right now, the federal minimum for reserve requirements is 10%, but this is based only on what the banks use to invest, meaning they can invest 90% of their clients' deposits. However, there are no current restrictions over how much banks are able to borrow from other banks. This became a problem in the 2000s when many smaller banks began to invest, or not invest, but to borrow more money than their entire worth from larger banks in order to buy mortgage-backed securities. And the problem with these heavily leveraged banks is that they depended on a steady income from their investments. And when these investments failed, the commercial banks were no longer able to meet the reserve requirements and were forced into bankruptcy. By prohibiting banks from taking out combined loans greater than 50% of their reserve, we can limit the amount of investment risk that banks are able to expose their clients' money to. Furthermore, this protects the continuity of the banking infrastructure in the event of failed investments, so that even if a bank's investments do fall through and don't make any money, they're still going to be able to stay open and keep the basic financial infrastructure of the country alive without relying on stimulus projects and bailouts like those used in 2008. Anticipating this proposal means that by imposing more restrictions based on reserve requirements, banks would probably have to forego many investments they would otherwise make or be forced to keep larger minimum reserves. This would essentially have the same effect as increasing reserve requirements altogether, because it would force banks to reduce their lending and ultimately decrease the money supply. So you would see a situation in which the money supply is reduced, and in the short run this would increase the interest rate. In the long run, aggregate prices would fall and return interest rates back to the original level of R1. The proposal is to limit high-risk commercial investments. I believe that the federal government should impose a limit on what percentage of commercial banks' investments may carry AA or below credit ratings, that they should ban the selling of home loans from commercial banks to investment banks, and that they should limit the amount of capital that commercial banks may use in proprietary investments, meaning that they should not be able to use maybe more than 3% of their total revenue on investments that do not directly benefit their clientele. Now, the results of this would be that it would protect homeowners against predatory lending practices, such as the no-income, no-asset loans that we discussed earlier. If you remember, the no-income, no-asset loans and the mortgage-backed securities were a huge reason why home prices were driven up artificially. By protecting homeowners against these practices, it's conceivable that we would be able to prevent unnecessary price inflation. Furthermore, we should limit high-risk commercial investments because it protects federally insured deposits from risky investment. Now, 2008 proved that the U.S. government really does consider many of our major banking organizations too big to fail, meaning that if they do work themselves into a dire enough position that it's either bail them out or let them collapse, the government will use taxpayer dollars to bail them out. This means their deposits are basically federally insured, and this means that they have a responsibility not to expose taxpayers or the federal governments to unnecessary risk. The limiting high-risk commercial investments also serves to restore faith in the credit and loan system. Once again, by restoring investors' trust in the credit and loan system, we're able to get more investment spending, which will help grow industries and create jobs. And in conclusion, these three policy proposals serve our three economic goals of low inflation, economic growth, and low unemployment. Thank you.